Hello, everyone. Pat Smita here with your Thursday, March the 13th daily interest rate update. We did get some inflation related data, producer price index, which is the inflation that producers and businesses pay in the US, went from zero point 0.6 to really flat. So we saw no inflation month over month. And annually, we went from 3.3 to 3.2%, which is really good news. At the same time, weekly jobless claims were relatively unchanged. We went from a previous reading of 222,000 to an actual rating of 220,000 on initial jobless claims, and ongoing jobless claims went from 1.897 million to 1.870 million. Now, it's not a great statistical change, but at least we're kind of staying flat. But remember, these numbers don't yet reflect the changes being made in the federal government with a lot of folks being laid off. At the same time, on Wednesday, we did get the consumer price index where we saw once again the inflation paid by the consumer going lower from last month from 0.5% to 0.2%. So we saw inflation get better. At the same time, the annual inflation went from 2.9% to 2.8%. But remember, this lower inflation is probably on the heels that people are starting to cut back. They're really worried about what's going on with the stock market, with the slowing economy, and they're really worried that that a recession may be around the corner. So what we saw intraday today was that the mortgage-backed security market did really well. So we were up 7 basis points on the inflation news from producer price index. And remember, when the value goes higher on the mortgage-backed securities, interest rates go lower. So as we see here, we saw some really nice movement throughout the day, ending the market higher. At the same time, what we're seeing here is for the last couple of days, as we saw some really nice growth in the mortgage-backed security market, last couple of days have really flattened out, and this is really the tariff wars, the trade wars that are starting to happen between Canada, Mexico, and the European Union. Now, Mexico is kind of on hold until April the 2nd, but with Canada, we're starting to see more and more tariffs being applied, whether it's to parts, energy, uh, steel and aluminum and all of that. And essentially, what we're also starting to see in Canadian supermarkets and Canadian stores, they're stopping to sell U.S. goods, or if they're still selling them, they're just kind of sitting there and they're letting everybody know what's a U.S. good and what's not because of these tariff wars. We're seeing the same in Europe, where at first President Trump levied tariffs on aluminum and steel products. European Union responded by levying tariffs on American whiskey and distilled spirits. And today, President Trump threatened to retaliate by putting 200% tariffs on European alcoholic drinks. So we're starting to see these tariff wars really heat up. At the same time, we had really nice movement on the 10-year bond yield. It really went lower, and it's been going lower the last couple of days because if you notice, the stock market has been underperforming, losing sometimes as much as 600, 700 points a day. And what you're starting to see is a classic flight to safety where people are buying bonds instead of stocks. And we see a really nice movement. If this continues and we can break below this 4.126 level, we will see rates really start to fall. So finally, on the scenario that we usually put up here, if you have a scenario where somebody's buying $1 million home, putting 20% down with an excellent credit score, we can do 5.75% on a 7/6 arm with a payment of about 46.68. Now, this was a little bit lower, but it's still really low numbers that we've seen over the last year. So please keep that in mind if we can help. And finally, as always, if you like the videos that you see, please follow us, please like the video, please comment, and please share with your partners and clients. Take care.